Everyone, hope they're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions. As we go through it together, it's generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in, take a look, see what people are sharing. If you want to follow me at Finding, join our community, finding-value.com. We have a special going on. The coupon code is special that you need to type in. It's 50% off the first month and the first month only. And you can get a larger discount on the yearly membership if you like to sign up. And that's where I dive deeper into these topics, looking at potential investment opportunities and sharing all of that stuff with the community. I also go over the fundamentals of sectors and companies and all that stuff. So Mike Zaccardi says, rich own stocks, low middle class own real estate. And, this is a comment that he's got, but I just want to make a comment on top of it. So I think what this is talking about is the top 1%, which has a lot of excess income. Of course, they're going to own a bunch of equities. They've got cash, equities, real estate, pensions, debt, and durables, and there's an other category. That's the top 1%. Now, the bottom 50% of the portfolio, more than likely, the house that they live in is going to make up the majority of their net worth. So it would make sense that real estate would be a larger chunk of their portfolio at the bottom 50% if they own a home. Otherwise, if they don't own a home, they're not going to have much cash. They're not going to have much equities. They're not going to really have much of anything. So it really depends on kind of how you look at this, because if you're going to spend something, you're going to spend it on real estate or buying a house. And then if your monthly payment is tight, of course, everything is going towards real estate. So I don't know. It just makes sense to me that this here, using the bottom 50% versus the top 1%. If you're overflowing with a bunch of cash, then yeah, go buy a bunch of businesses or equity in a bunch of companies. It makes sense to me. So I'm not so surprised by this chart or data here, given the bottom 50% against the top 1% of equity holdings. Here's Razor Oil. He says, an unpopular view, most discussed topic, U.S. tariffs on Canadian oil. The least discussed topic is the USD Canadian exchange rate. And if you think about it, the balance sheets will likely output the same. Adjusted funds flow number after the above variables neutralize each other, in his opinion. Now, here's one thing that I want to talk about. These U.S. tariffs. We have put tariffs on Canada and on Mexico. Those are two very large natural resource countries. In particular, there are critical minerals that are in those two countries that I'm sure we are importing to the United States. If those minerals are running big deficits, like, say, silver, for example, and the deficits are quite large, say 400 million ounce deficits per year, doesn't that mean you have options to sell it somewhere else if the United States is going to charge more money? Maybe they pay the same and they're going to add the tariff to the end user in the United States. Tough to say how this gets paid, since the whole commodity complex is kind of weird with this tariff thing. So I'm interested to see if they just divert flows to other areas versus America. Just curious. Martin Pelletier says, Trump would rather do business with Venezuela than Canada. Let's unite against the tyrant and diversify our markets for resources. Well, that very well could occur. I don't know how they levy these tariffs. I don't know if the end consumer in the United States pays the tariff, or if it somehow works its way back to the country providing the commodity or whatever it is. So that is an option, is that if tariffs do impede the profitability of companies in those countries, well, then just divert your resources to someone else. especially if those resources are scarce in the marketplace and people are willing to buy them. So that is perfectly fine. And that's what I would do if someone was trying to run amok against me. I'd say, all right, I'll just sell it to someone else. Ronnie Stofferle says, great copper chart by Azim Habib. So this is gold. We've got the big 2000s bull market. We've got another kind of cup and handle and a breakout. Copper is exhibiting the same exact pattern as gold, just delayed behind gold. Now, gold's already broken out. It's running like a madman. Copper hasn't broken out yet. The only thing I'll say with copper is a lot of the ways to play copper are through these big diversified mining companies. It's not a direct play. There are some, I think, ETFs that directly play copper. Some people would say, well, play physical copper. I mean, guys, you can buy a lot of copper for not a lot of money. I mean, let's get real here. What are we going to do? Start filling up garbage cans full of pennies or something? like what's the play on copper here from a physical perspective? That's kind of ridiculous. So gold is our leader. Gold is what prices everything higher. Everything will go up and follow gold at some point. Copper, oil, platinum, palladium, everything. And some of them will be highly leveraged to the move higher. So this is copper. Copper looks fantastic. I'm sure it will break higher at some point, and gold is our leader. North Star, so this is FedEx, which is a company, versus gold. Dome of Doom continues to play out. What he's doing is he's taking large, successful companies that might be a representation of normal businesses in the market, comparing it against gold. And what is happening? We are getting a big topping pattern, and we are starting to underperform gold. What does that mean? What he's doing is he's looking for evidence in the market of companies that are starting to underperform gold. It's a changing market condition. That is the big takeaway. This market condition, where it started in 1979. 1979, big move up, kind of a breakout lower in 87, sideways action, and then we broke out again. This was a commodity bull market right here, this consolidation. From late 80s to 1990, where we had that recession, which is 90 is right here. We came out of that with a lowering of interest rates and pushed it all the way up to the peak of 2003 or 4 or 5, somewhere in that range. It peaked out, broke the uptrend line, pulled way back during the commodity bull market of 99, 2000, all the way to 2011. It pulled up again, and now we are struggling to make new highs against gold. We just recently broke out of another trend line with a pretty big bearish engulfing candlestick, which is pretty bearish, where gold is going to outperform FedEx. What does all this mean? It means that the market conditions are changing, and they could be changing rapidly from here on out as gold starts to outperform a lot of the businesses in America. Think of it as a couple of things that are driving it. Inflation is ultimately driving it. Interest rates chase inflation, and then the net present value adjusted to the interest rate prices these really expensive stocks. FedEx is probably one of them. And then it prices them lower on a price to earnings multiple. And we could go much lower against gold, against oil, against a whole bunch of different commodities. This is a changing market condition, and what this is telling us is that a gigantic bull market is right in front of us. That is what it's saying. So I'm positioned for that commodity bull market to materialize, and I am not invested in a lot of these companies that are going to underperform. Gold is a great way, a great measuring stick to look at this stuff. Tariffs are taxes, and taxes are bad. I completely agree with Rick Rule here. 100%. All taxes are bad. I don't care if it's tariffs. I don't care if it's federal income tax, a state tax. I don't care. A tax is a tax. It is legalized theft. So taxing domestic businesses raises the prices of goods. Taxing international businesses also raises prices. This really isn't difficult. It's an effect that we can all see with our own eyes. So why are so many people blinding themselves to reality? It's pretty true. Taxes are bad. Howard Marks says people should wake up in the morning and start the day by practicing, I don't know, I don't know. It's a great thing to say, and not enough people say it. And then the next remark from Warren Buffett is, if I don't know, I don't invest. I love it. Peter says, who will be buying all of the sweet Mexican silver production now that the USA is imposing a 25% tax? Lots of hungry global silver buyers. USA just priced itself out of the market while mining and exploitation in the USA still facing difficulties with regulatory agencies. I think he means mining and exploration, but he has exploitation there. But yeah, what does this mean with this tariff? Is it directly imposed on the country, and does that country pay it? If that's the case, why the heck would I sell my silver to America if I could go bypass it and sell it to China or India or somewhere else that's willing to take it? I mean, are we just pricing ourselves out? Is there another underlying basis for why he's doing this? I don't know. But it does seem a little bit weird, and it could divert flows differently than what they were before to other countries. North Star says the chart suggests gold is about to substantially outperform the US dollar index. Therefore, however strong the US dollar might be, gold should continue going up. Brent Johnson milkshake in action question mark. I don't know if this is even a good ratio here. He's got the DXY divided by gold priced in dollars. So this would essentially be, I mean, so if you use a ratio, gold is a ratio. Gold is priced in dollars. But then you have the DXY divided by gold. So it's really the DXY times the USD divided by the gold price. I don't know if that's an accurate measuring stick. Maybe it is, maybe it isn't. But I think the way that this is priced might not be correct. So really what this price is gold outperforming everything? No, yeah, this is not a good measuring stick. It is gold priced in dollars, so that's a ratio. And then you've got the ratio on top of the DXY, which is really the dollar in relationship to all the foreign currencies. So if you were to divide that, you flip that upside down, you would have dollar times dollar divided by gold divided by other, the yen and other currencies. That's what this is measuring. And it's just saying that emerging markets and gold, not emerging markets, the yen, Great British pound, euro, whatever else is in there, multiplied by gold is going to outperform the dollar squared. You got to be careful with your ratios here, guys. Goldman Sachs traders are long gold now. Welcome to the party. I don't really care if they're part of this or not. I'm going to be long either way. But I guess Goldman Sachs is now saying they're going to go long. Does that mean gold's going to go down? I don't know. Seems like they always release the opposite information. Eric Yoon says, remember the golden rule of negotiating. He who has the gold makes the rules. Midas touch. Who has all the gold, guys? India's oil demand increased by more than 2 million barrels a day, and its oil imports increased by 1.22 million barrels per day in the last 10 years. India's oil demand is expected to increase by another 2 million barrels per day in the next 10 years. India will become the third largest economy in the world in a few years. Imagine the energy demand and supply chain needed is what he's referring to here, which I've talked about before. Rand Paul says tariffs are simply taxes. Conservatives once united against new taxes. Taxing trade will mean less trade and higher prices. That's exactly right. 100%. This is gold priced in dollars. We've got the highest monthly close in history. Bottom left to top right, and this is nothing compared to what is coming. For those who have followed and believed our forecast since 2019, well done, and thank you for sticking around. Now hold on tight. It may get bumpy as the capital rotation event approaches. And he says this move is nothing compared to what comes after the capital rotation event. That just means that capital is going to rotate differently in the market, maybe not even Um, it's going to go away from certain asset classes into commodities and precious metals. Whenever they say tariffs, just buy more stocks, particularly the Chinese ones. So China versus India, and China's breaking out from its bottom here, looking pretty solid on this downtrend break of the ratio. Brady says, remember that precious metals often takes you to your emotional edge and over that edge. The PM bull simply wants as few on board as possible. In playing PM, you need your big pants on. And if you focus on bias, emotions, macro overthinking, why, news, etc., you will struggle. I don't know. I've just been in PMs. I've been accumulating for a long time. The ratios tell me I should be there. They look far cheaper and far better than anything else on a risk-adjusted basis. Uh, I'm in it. I don't need any pants on for me to be in precious metals. I don't need big boy pants. I don't need small boy pants. In fact, I'm wearing shorts, so that's what I think. Capital rotation process, another one. This is NASDAQ priced in gold. He says it gets really skittish for stock markets, Bitcoin and friends, once the NASDAQ versus gold chart closes below the rising trend line. NASDAQ has had a chance to break out versus gold and has so far been unable to do so. Momentum is weak, clock is ticking. So this is the NASDAQ priced in gold. You can see increased odds of a bull era for precious metals below this line. It will also be oil and other commodities that break out with this thing. We also have diminishing momentum that's rolling over. We have another trend line break to the downside retest, and we could see another momentum shift in favor of gold over the NASDAQ. The reason I'm going over this so much and trying to drill this through is because when this turns completely, money flows are really going to start to change. And we're going to see big moves in commodities, gold. And I think we've already started it. Like we're just at the beginning of it. Let's talk about Peter Schiff here. He says 25% tariffs on goods coming in from Mexico and Canada are not a disaster for Canada or Mexico. There will be declines in U.S. sales, but those countries can still consume those goods domestically or export them to other nations. So companies making those goods will see profits fall for the portion of their sales that go to the next highest bidders. But Americans will be paying higher prices on all Canadian and Mexican imports they buy, or for higher priced domestic substitutes where available. But many lower income Americans will be priced out of the market for those goods entirely. So the tariffs portend more negative consequences for Americans than they do for Canadians and Mexicans. If either Mexico or Canada retaliates with tariffs of their own, the effect will be the same. Their own citizens will suffer more than Americans. That is the unique nature of a trade war. Each side suffers most from its own offensive. The best way for Mexico and Canada to win is not to retaliate. That would include not providing any subsidies to exporters or any attempt to weaken their currencies. That would only reduce the sting tariffs have on Americans, shift the burden to their own people, and prolong the trade war. So what he's saying is don't weaken your currency, keep it strong, and just don't sell to Americans if you're in Canada and Mexico. That's what I would do. Yep, if you can do that. Here's another capital rotation event. I'm going to continue to go over these as we go. Gold to SPX ratio is currently at 0.4632. The first big warning's at 0.485. The capital rotation event confirmed at 0.5, which is the horizontal line. Be ready to act accordingly. I'm already acted. I'm in this stuff, and I'm just waiting for all this to break out. So we're also seeing this event with gold starting to outperform the S&P 500, and we're ready for the potential breakout. With gold reaching new highs, it's only natural to ask whether it's overvalued. Yet, when adjusted for the U.S. money supply, gold prices remain nearly 80% below their 1980 peak. With central banks urgently accumulating the metal worldwide, a return to those levels wouldn't be surprising. This reinforces the likelihood that we are entering a long-term bullish trend for gold. Even more importantly, gold money supply terms is currently on the verge of a 45-year breakout of this downtrend to the upside. What happens is under certain market conditions, gold accounts for the money supply. Right now, the money supply is over in tech stocks and financial assets. When that money starts to rotate over, historically, if we see a big bull market with increasing interest rates, we could peak somewhere at the top here where gold goes all the way up against the M2 money supply under that market condition. The market condition are these capital rotation events where capital rotates out of the S&P and NASDAQ and all those companies into gold and commodities. That's what all of these charts are basically saying on these big capital rotation event charts. Here's In Gold We Trust. We will keep posting this chart every month until the median is reached. Who is with us? This is commodity divided by the S&P 500 ratio. We are at incredibly low levels, below 1999, below 1971. We are very low. We have a long way to go higher for commodities to outperform the S&P 500 ratio. This is a big, big deal and a huge opportunity for anyone who's looking and is patient enough for this to play out. We are going to see decades of returns in way less than a decade. And when you get these capital rotation events, if you're in the right asset classes, if you're in the right companies, they could do 10, 20, 30, 40, 100, maybe even 1,000 times your money in a decade or less, depending on if you get the company right. Now, getting a 1,000 bagger is tough. There's no doubt about it. And you're going to have a lot of luck on your side. So you're going to have to pick something early and have it be successful throughout that decade as prices increase. Paladin Energy was one of those successes last bull market. And there was other ones too in oil and natural gas and in other areas last bull market. For me, the true mind-blowing run for silver junior miners starts when SILJ ETF is above $18 a share. Whatever happens before is simply the pregame show. So this is silver junior miners. There's 9 years in the making. We've got this big horizontal resistance line, and we've been going up, hit the resistance, and we want to break through that. If we break through that, I think we are going to run. The rocket ship in the background here is completely right. We do need to get above a lot of these high volume nodes that we have created. It's going to take a little bit of time, and then we'll see if we can bust through this thing. It may be later 2020s. Whenever it does bust, it's going to be a big, big move out in the future. Silver and platinum are the lowest valued metals on the planet. Make good use of this historical opportunity. I love how sweet and short this is. Totally true. High Heat says, in 2003, Saudi Arabia consumed around about 2 million barrels per day of oil. By December 2024, this had increased to 4.5 million barrels per day of oil, marking a substantial rise in domestic oil use. Where did the spare capacity go, Grandpa? They are eating through their spare capacity the past 20 years of 2.5 million barrels. So if internal demand of your oil goes up, your exportable capacity declines. And this is happening in all of the exportable countries. Almost all of them. They're getting declining exportable capacity. And that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. A special coupon code if you'd like to use it. And we'll catch you guys later. This is Finding Value.